In financial markets, many traders drift within a great chaos without even realizing it while trying to predict where prices will go. Some look at complex charts, some follow hearsay news, and others risk their capital by relying solely on their instincts. However, Larry Connors took a completely different path from this traditional way and opened a brand new door. His entire approach actually rests on a single, unwavering principle. Stop predicting, start measuring, test everything, and find a statistical advantage, a real edge. For Larry Connors, who is considered the greatest authority on mean reversion strategies in the modern short-term trading world, technical analysis is not an art or a field of subjective interpretation, but a purely quantitative research domain. Today, we will look into Larry Connors' data-driven world and the deep technical analysis secrets that will turn an ordinary trader into a professional data miner. Larry Connors' perspective on the markets stands on three main pillars: quantitative trading, the logic of mean reversion, and measuring human behavior mathematically. According to Connors, the biggest and most costly mistake in technical analysis is for traders to include their own ideas, hopes, and personal interpretations of the market into their trades. He says, opinions are worthless. Data is everything. Because of this, every single strategy he has developed has gone through decades of backtests, been measured in thousands of different market conditions, and is based on a non-random, repeatable advantage. The famous trend lines, head and shoulders patterns, or subjective triangle interpretations we see in classic technical analysis books find no place in Connors' world. His approach is clear. Every idea, every indicator, and every strategy must be tested. Connors and his team have examined hundreds of indicators, thousands of different parameters, and all the market data from the last 30 to 40 years as if they were in a laboratory. As he emphasizes in his work, How Markets Really Work, market behavior is not random noise, but a process that can be statistically analyzed and fitted into specific patterns. At the heart of this philosophy lies mean reversion. Connors' research on massive datasets has revealed that markets exhibit two fundamental characters. Prices show a trend bias in the long run, but in the short term, they have an absolute reflex to return to the mean. We can compare this to a rubber band. When the price moves too far from the main direction, the band stretches and at some point makes a violent return toward the center. Connors' systems with the highest success rates are based on this golden formula. Trend plus pullback equals a high probability trade. If the main direction, for example, the big trend determined by the 200-day moving average, is up and the price has been oversold due to a panic in the short term, this is an unmissable opportunity for a professional trader. Larry Connors' most significant impact on the trading world was radically changing how the classic RSI indicator is used. The standard 14-period RSI, which has been on almost every trader's screen since the 1970s, did not produce a noteworthy statistical advantage in short-term trading according to Connors' tests. He began playing with the parameters and arrived at the 2-period RSI by radically reducing the period. Thus, the RSI-2 strategy, used today by thousands of professionals worldwide, was born. The logic of this strategy has an immense simplicity. In the first step, you use the 200-day moving average as a filter. If the price is above this average, you only look for buying opportunities. In the second step, you wait for the 2-period RSI to drop below the 10 level. Such a low RSI is mathematical proof that the sellers in the market are exhausted and that buyers could step in at any moment. For the exit, you wait for the price to return to its average, meaning the RSI-2 moves back above the 70 level. Instead of drowning in complex analyses, this system puts the two most fundamental emotions of the market, fear and greed, into a mathematical discipline. Connors did not stop there. He designed a more advanced indicator called Connors RSI. This tool does not just look at where the price is, it takes the pulse of the market by bringing together three critical components. The first component is short-term RSI. The second component is streak length, which is how many days in a row the price has fallen or risen. The third component is price change percentile, which is how extreme the current price change is compared to the past. When these three pieces of data combine, a much more sensitive value between 0 and 100 emerges. Connors' RSI tells us when the market has truly reached an extreme point. However, Connors reminds us of a very important point here. The indicator is just a tool. The real edge is human behavior. When the RSI enters the oversold zone, it actually shows that people in the market have fallen into an irrational fear. Connors has found a way to turn these irrational moments into rational gains. The most striking feature that sets his strategies apart is the incredible win rates ranging from 75% to 85%. Instead of chasing trends that last for months, Larry Connors opens positions for 3 to 5 days, taking advantage of these short-term imbalances in the market. For him, trading is the job of collecting small but high-probability advantages every day. The strategies he explains in his book, High Probability ETF Trading, are like a holy book, especially for those working on exchange-traded funds. For example, systems like the 3-day high-low strategy or the Bollinger %B strategy always rely on the same unwavering logic. When the market moves very fast in one direction, the probability of that movement making a correction is statistically very high. Regarding risk management and stop losses, Connors has a rather provocative and controversial view. In the thousands of tests he conducted, he noticed that using very tight stop losses, especially in mean reversion strategies, reduced the expectancy or the expected profitability of the system. This is because it is natural for the price to stretch a bit more and then return in mean reversion systems. A very tight stop kicks you out of the game before you can see that return. Therefore, instead of fixed stops, Connors advocates for dynamic exit strategies, such as the price touching its 5-day moving average. This approach is only suitable for traders who fully trust the data and have completely sidelined their emotions. He has such a radical quantitative discipline that he would say, if the data shows that setting a stop reduces profit, then we should not set a stop. The real power behind Larry Connors' success is seeing the market as a character. According to him, the market is like a living creature that behaves manic-depressively from time to time. One day it can be overly enthusiastic and inflate prices, and the next day it can fall into a deep depression and sell in a panic. Warren Buffett's famous phrase, "Be greedy when others are fearful," has turned into a money machine working with RSI-2 and the 200-day average in Connors' hands. For him, technical analysis is not fortune-telling. It is probability management. His quote, "Trading is the search for quantified edges," is the summary of his entire career. Now, let's stop for a moment and dive deeper into this philosophy. Why can Connors' system stay standing for decades while most traders fail? Because he doesn't try to beat the market. He uses the market's own nature. People will always be afraid and they will always be greedy. This is a part of human evolution, and as long as markets exist, these emotional fluctuations will continue. Connors managed to express these fluctuations in a mathematical language. With the cold-bloodedness of a computer algorithm, he taught the discipline of pressing the button in those most terrifying moments when the data says, "Buy now." When we reconsider the factors that made him successful, his identity as a researcher who constantly tests, his view of fear and greed in human psychology as a data set, and his preference for simple but unwavering rules over complex systems stand out. Systems consisting of only a few rules, like RSI-2, are actually the most effective ones amidst the chaos of the market. Connors teaches us this. The more indicators you use, the more indecisive you become. The essence is the price, the extremes in the price, and the necessity of those extremes to return to the mean. So, how can we integrate these strategies into our own lives? The first step is to get rid of all our prejudices about the market. A stock or a coin is not bought just because it has dropped a lot, but because that drop is proven to be statistically extreme. Larry Connors advises us to be a risk manager and a probability expert beyond just being a trader. Determine your own rules, test these rules with historical data, and stay loyal to the results no matter what. Remember that trading is not a way to get rich overnight, but the art of growing capital in a disciplined manner. In conclusion, Larry Connors has transformed technical analysis from a subjective art form into a grounded science. His work has left us 3 giant lessons. First lesson, the engine of market movements is human psychology, and this psychology is measurable. Second lesson, in the short term, mean reversion is the strongest statistical force in the market. Third lesson, no idea should be traded without strong backtest data behind it. Even in today's modern, algorithmic, and AI-driven markets, these classic rules of Connors still maintain their validity. When you stop predicting and start measuring, when you strip away your personal opinions and surrender to the data, you stop drowning in the noisy waves of the market and turn into a professional surfer who converts those waves into profit. Larry Connors' path is the path of patience, mathematics, and steel-like discipline. When you integrate these rules into your own trading life, you become not just a trader, but a strategist who calmly turns moments of fear and panic in the market into opportunities. Because great gains belong to those who dare to follow the path illuminated by data in those dark moments when everyone else is afraid. Thank you for listening. In the next episode, we will continue to discover new paths in the light of data.